We're also following breaking news from Wall Street this morning. Right now, the Dow Jones Industrial Average is down. It's been down as much as 1,400 points. It's now down about 1,050 points. That's just the Dow Jones. And we look at the NASDAQ and all the other indicators. Look at this. Standard & Poor's down 155. NASDAQ down 568 points. I mean, 1,000 drop in this morning is just extraordinary. This follows a sell-off in other global markets as well, blamed on worries the U.S. economy may be heading for a recession after last Friday's jobs report. With us now is CNBC's Dominic Chu. Dom, good morning. What exactly is going on here? And when we look at what's happening in Japan and the markets, some other markets in Asia, I mean, this is really massive sell-offs.
Yes, and you put the point numbers on the board to tell listeners and viewers about. Let me put it in percentage terms as well for those people who kind of get a better grasp about the percentage side of things. We're talking about declines in roughly the 2.5% to 3.5% declines for that tech-heavier NASDAQ composite index. So now, at this point, there are a number of contextual superlatives, if you will, that are currently in play given the severity of the sell-off. With things currently standing the way they are, if we hold near these declines for the Dow and the S&P, those indices would be on pace for their worst three-day stretch since the declines that we saw in mid-June of 2022. If it gets markedly worse from here for the day, for the tech-heavier NASDAQ composite index, for example, at one point this morning, it was going to be the worst one of those stretches since the big sell-off in stocks during the early days of the COVID pandemic, going all the way back to March of 2020. Now, I bring up the NASDAQ specifically because it is arguably the epicenter of the big sell-off that's been happening over the course of the last week. Mega-cap technology stocks like Microsoft, Google parent company Alphabet, computer chip giant NVIDIA have seen hundreds of billions of dollars shaved off their value just since the recent highs that we saw back in July. Now, the market story is evolving from one where good news is bad news and bad news is good news to one that is more focused on a straightforward good news is good news and bad news is bad news scenario. What I mean by that is it's very much about the economy, as you point out, and interest rates by extension. The story shift has gone from one where inflation remained the primary worry in this country to one where there is a fear now that the U.S. could be entering a recession, which would hypothetically solve the inflation problem, but at what cost? So is it worse to have an economic downturn or have stubbornly high inflation? For now, the inflation story has seen a lot more of the air let out of it. We're seeing drops in the stock market, in certain parts of the real estate market. Copper prices, which are used as a proxy for building and construction, have hit the lowest levels since March. Now, all of this is happening as traders wonder if the Federal Reserve will act more forcefully on lowering interest rates at some point. It was not that long ago, you may recall, that markets were pricing in maybe one interest rate cut, maybe at the end of the year after the election. Now that probability is almost a certain interest rate cut at the next meeting in September, with multiple interest rate cuts for the balance of the year. And that's where we currently stand, Jose. It is one where a lot of folks on Wall Street are trying to figure out if it is worse to have a recession or worse to have that lingering problem of inflation. And that's what the markets are pricing in right now.
So, Dom, I'm just looking at, the people who have 401ks in some way, and almost everybody who has a 401k is directly tied to the stock market. You're saying that this kind of drop, and in Japan, I think it dropped more than 12% just today, the value of the entire market. But I'm just wondering, you talk about how that last time when there was COVID and everybody panicked, how big of a panic is it today to see this around the world?
So one of the ways that many traders and investors in Wall Street look at how much panic or fear there is in a volatility index that's tied to the value of the S&P 500. What we have seen is a massive elevation in that kind of fear index, if you will, to levels that we haven't really seen since some of those days in the pandemic. Now, the issue becomes how long it stays in that kind of an elevated volatility regime. If you are looking at this from your retirement savings 401k perspective, a lot of times what this will do is lend financial advisors and their clients to talk about just how much risk tolerance there is for them at these levels. For example, if you are getting ready to retire imminently in the next 1 or 2 or 3 years, or you're looking to use the money for a college education or buying a home, putting a down payment on one, then your risk tolerance is a lot less than those who have maybe 20, 30, 40 years before they need to use that kind of money. So in this kind of a downside scenario, it is one where many folks will be looking at, talking to their financial advisors about what this means for their track to places like retirement. It is not one, Jose, where there is panic yet, but it is definitely elevated with regard to kind of the uncertainty level around the economy over the next 6 to 12 months.
Dominic Chu, thank you so very much.